So good morning. My name is Natalie Greenberg. I'm the current president of UCLA Real Estate Alumni Group, or REAG. We're honored to have each of you here with us, and thank you for joining us for the special speaker series with Victor Coleman and Daniel Duquesnian. For those of you who are unfamiliar with REAG, we're a nonprofit group that's 100% membership based, and we're open to any UCLA graduate. If there are any Bruins out there that are not familiar with us or would like to join us, I encourage you to check us out online. Before we get started, I just want to thank a few people. Thank you to the Ziman Center for your continued support of excellence and your dedication to our organization. Thank you to Daniel and the entire REAG board and all the volunteers that put their time to make this event happen. Thank you to our sponsors, Jan Horowitz, Juniper Square, and CGS3, who actually fund 50% of our annual budget. And finally, thank you to the Hudson Pacific team that worked with us to put this event together. Our moderator today is Daniel Duquesnian. Daniel is the principal of the Mulholland Drive Company, a real estate investment and development firm based in LA and with interests in assets across geographies and product types. Daniel has transacted on over $1 billion worth of real estate projects across tenures at New York-based real estate investment banks and development companies in California. He has a bachelor's degree from UCLA and a master's from Columbia University. We're also grateful to have him on our REAG board. Victor Coleman is the CEO and chairman of Hudson Pacific Properties. He was the founder and managing partner of Hudson Pacific's predecessor, Hudson Capital. He previously co-founded and led Arden Realty as its president and CEO and as a director. Coleman serves on the boards of the Ronald Reagan UCLA Medical Center, the Fisher Center for Real Estate and Urban Economics, the Los Angeles Sports and Entertainment Commission, and the YPO's Gold Los Angeles. Coleman previously served on boards of several public companies, including Douglas Emmett, and he currently serves as a trustee on the board of Kite Realty. He holds an MBA degree from Golden Gate University and a BA from the University of California, Berkeley. And I abbreviated all this just because I wanted to give you guys time, but Victor is involved in a lot of other things as well. So before I turn the floor over to Daniel, just a few quick housekeeping things. Let's talk about the format. We're gonna end at 10:45 on the dot. And several attendees have emailed us questions ahead of time, which Daniel and Victor are already working into their agenda. But if there are any questions that pop up during the session, just chat them to me directly. And if we have time at the end of the session, then we'll be able to open it up for questions. So at this point, I will give it over to Daniel. Thank you.
All right. Thank you so much, Natalie. Thank you so much, Victor, for joining us. Great to be speaking with you. First of all, how's it going? I see you're in your office, sunny day in Los Angeles. You decided to brave it out and go in. Is the office back open or?
So, hey Daniel, how are you? Thanks everybody for inviting me, and I hope you're all well. So yeah, we because we're a real estate company, we never closed. Technically, we had to keep all of our assets open. The tenants are the choice to come in or not. From a company standpoint, we had a skeleton crew from day one. Interestingly enough, there have been several individuals that have been here virtually every single day. I think, I believe it was June 1st, we opened somewhere between 30 to 50% of our in-house portfolio throughout the West Coast. And so we've had up to about more like 30 to 40. There are certain days we did a couple of busier days where we had transactions and things like that going on, that we had more people in, but we've really been, at that rate since June. And I'm not so sure that we're going to get any higher than that. We've got alternate days, Monday, Wednesdays, Tuesdays, Thursdays, and we're not going to probably change that until September 1st is my guess.
Got it. Well, we really want to get into obviously the coronavirus, the current economy, how that's affected Hudson Pacific, what your thoughts are on that and the economy. But I think I want to start with probably the number one requested question and discussion topic that the audience submitted, which is the Blackstone JV that was announced, I think, just last week, hot off the press. Perhaps maybe you could tell us a little bit about the deal, kind of how it came about, whether the coronavirus is the reason or part of the reason that it happened, what the goals are, and then I have some more specific questions to ask you after that.
Sure, Daniel. So first of all, really proud of our team. This is the largest real estate transaction done in the United States post-COVID. this was a deal that we were working on pre-COVID. To recap the studio portfolio, we had 3 candidates that we were in conversations and diligence with, going back and forth. All 3 submitted pre, all 3 submitted post COVID. Clearly, it's not a surprise to most people knowing our relationship with Blackstone, and this would be in Hudson's tenor. This would be the 4th transaction we've done with them, the 2nd largest deal, the largest being about a $3.6 billion transaction, and the smallest being about a $600 million transaction. So we've done a lot of business with them. They've been great partners with us, and this is just sort of a process of our relationship going forward. You know, Blackstone has changed their investment mentality in the last 12 months to become more of as opposed to an asset investor. They are more of an enterprise investor. They're looking to invest in existing vehicles or putting vehicles in place and growing those vehicles. And this was something that they were interested in for quite some time. And we've had lots of conversations over the last couple of years about having them be part of this portfolio. And it was expedited really in late December. And we started the process, as I said, pre-COVID. And it did take a little longer, and it had a few bumps along the way, but you know, nothing to be shied away from both teams and the desire to get this done. So we're really happy. It's going to be a growth platform going forward. We've already got several assets that we've identified in other markets. You know, right now we're in Los Angeles and Vancouver with them. We're looking to build up in Vancouver, build here in Los Angeles. We're looking to build up the portfolio in New York and in London. And so there's some opportunities in other markets too, but those are our 4 main markets from a growth standpoint.
Got it. Well, you touched a bit on how you chose Blackstone over a few other equity groups you were talking to. I think I'm curious, what has, and like you said, you've done several deals with Blackstone now. What has made them such a good partner? I imagine, how do you align your interests, considering the fact that Blackstone's a private equity firm? Private equity firms generally have a shorter term time horizon than a Hudson Pacific, like that would be a REAG, that is obviously more of a long-term investor. So I'm curious how you reconcile the two.
So it's a great question, Daniel. You know, listen, from that standpoint, Blackstone and Hudson's relationship right now this being the 2nd existing deal that we have together. The first is about $1.5 billion asset portfolio of assets of five buildings in Vancouver, and both this Blackstone Hudson transaction for our media portfolio and our Vancouver Bentall Center portfolio are both in their core fund. And so that's a massive difference than other entities that have come to us who you're exactly right, as private investors have a much shorter term horizon. So their core fund is 10 plus years. There's a lot of variability throughout that. That's going to be longer than 10, but if it was only 10, we have buy-sell agreements and the likes of that. These are both asset quality portfolios that we have with them that is going to be long-term holds for Hudson. In the public markets, as you sort of surmised in your question, you know, we in the public markets are looking to hold the stuff we want to hold forever. And so whether Blackstone stays along for the ride or not, it's at least 10 years. And my guess is it will be longer with both, and the platform will grow. And we'll look for alternatives to figure out what we're going to do with that as we continue to grow. But the reality is that these is the core fund versus the op fund or the equity fund or the mezz funds, which are much more like 3 to 7 year holds. And so, you know, we're talking 2030 before you have to have a conversation.
Got it. Okay. That makes a lot of sense. You also mentioned there were bids pre-COVID. So a lot of people was on their minds is, did this deal happen because of the coronavirus? Did it impact it in some way? But it sounds like it was in the works previous to that. And if coronavirus had nothing to do with it, then what did prompt it? What are the goals of the JV? You know, is it to separate the creative office portfolio in Hudson Pacific's portfolio from entertainment related assets, or is it something else altogether?
So, listen, everybody who knows me knows I've been pretty passionate about this product type. We were the first institutional ownership to buy into this. We're the largest owner of independent studios in the country. And we've always wanted to grow our platform. And we never really had the value add in the public market. So, just sort of bare bone numbers, we contribute this valuation at a sub 6 cap, somewhere in the, I think it's right around 5.8 or so, something like that for the studios, and much lower for the office component. When the public markets was valuing this, at our stock valuation and equity market cap closer to 8. So we never had the valuation, and we want to grow this portfolio. As I mentioned, this is not a recapitalization and just take the money and do something with it. We're taking the money to grow. We, pre-COVID, we were in a very great scenario in terms of the balance sheet and our structure and liquidity. Post-COVID, this just adds another, $1.2 billion of liquidity to the company. So we have over $2.3 billion of liquidity right now for us to, basically invest into whatever we want to invest in. So it wasn't a need to transact based on liquidity or structure around the company. It was a need to grow the portfolio. And as I said, as you commented, it was a pre-negotiated transaction that just took a step back because everybody sort of put everything on hold. But once we sat down and went through it with them and the other two bidders, indicating our desire to close at certain timeframes, everybody stepped up. And so all three parties did step up. We just negotiated a better deal with Blackstone.
Got it. So if you're investing, you're growing the portfolio, I imagine obviously you're seeing you have positive you in your view there's a favorable outlook for the entertainment space industry and real estate. Do you think that is change? Obviously, people are staying home watching Netflix a lot more, for example, which is a huge, I think one of the largest, if not the largest tenant in Hudson Pacific's portfolio. It sounds like you're betting long on the entertainment space industry.
We are, listen, entertainment capital of the world is here in Los Angeles, as everybody knows. We're betting long on content, and we're betting long on providing services for content. So in this portfolio, it's not just real estate services that we provide in terms of four walls for stand stages or office space for tenants like Netflix, as you mentioned. It's providing the facilities and the services for those facilities for production. And so even pre-COVID, the voracious appetite of the new wave of content providers, whether it's Netflix, Apple, Amazon, Hulu, and YouTube with Google and the likes of that, and now the resurgence of the Disney Pluses and the HBO Plus and Peacock and the likes of that. But we were providing services to the second tier guards, which were the HBOs, the Showtimes, the Cinemaxes of the world, who also create their own content. And prior to that, the mainstream studios like Sony, Disney, Paramount, Fox, and the likes of that as well. So the number of players has increased, the amount of capital going into content has increased. What's happened is in COVID, now we see that the talent, both in front of the camera and behind the camera, wants to produce this content in their own markets. When before they were traveling around the world, I'm not so sure that's going to be the case initially. I mean, we are seeing filming already in places like Germany and Italy, in Switzerland, in Iceland, in Korea right now. Filming has started here in Los Angeles as of last Monday, but the majority of filming that you're going to see and the growth prospects from content is going to come out of Los Angeles starting August 1 and sort of kick through. You're right. A lot of people are home watching a lot more TV on the small screen than ever before and signing up for services. And you're going to see an increase in content from a dollar standpoint from all of these entities that we're spending, $1 billion, $2 billion, other than Netflix, that we're spending $12 billion a year on content. They're all increasing their appetite, and productivity in Los Angeles is key. The last piece is, as I said, people misconstrue content and real estate. Real estate is what we're providing. When they're producing the content, we're also providing services. We own an operating company. This is a complete OpCo business. So we provide lighting and grip and all amenity services to all of these tenants, from security to food, for telecommunications, everything that's there, we charge them. It's like an a la carte menu that you would have in a hotel. for an example. So that's part and parcel, and unless you really understand that end of the business, and that revenue stream is about 30% of the overall revenue stream that we get.
Got it. I'm very curious. In light of the current environment, like you said, there's a huge uptick in demand. Do you think that's a sustainable demand, or do you think that's going to be a temporary shift in demand that'll revert back if all these companies are investing a lot in content, like you said? Do you think there's going to be a glut of content? How are you mitigating that downside?
Well, I do think that we are in the early stages of content and content players. I think we are shifting from an old line guard to the new guard. The amount of capital that is going to be going into the content business is early as well. I think this is a long road. I think entertainment has always been counterintuitive in down times in the economy, in recessionary times. And so you're going to see huge players spend a lot of money. And so I'm very bullish on that when it comes to the Amazons and the Apples and the Netflix. I mean, we're talking billions and billions of dollars that they're all going to pour into it. So the next closest to that will be a Disney, who obviously bought Fox for that platform, for the Hulu platform that they can do outside of their Disney Plus platform to show different types of content. I do think that this race is going to be a long marathon, not a sprint. And the quality of content is moving towards home entertainment and pay-per-view, basically, or pay what you want for the series or the type of content that you want. Clearly, the post-COVID world of theaters is going to be altered, and it could be altered for some time, if not forever. So this only enhances the ability for these content players to provide more. I do think that we have seen a lack of content during these last 4 months being produced, and so everybody's been on the sidelines. There's been a lot of writers writing content. There's been a lot of table sits, like this, Zoom related, but they obviously haven't produced anything other than animation, which can be done without face-to-face contact. And so I do think you're going to find the content world is going to increase. Clearly, as I mentioned earlier, the capital is going to be here in Los Angeles, and I'm not worried about the surplus. It's interesting, the demand side on the office has increased during this downtime. Most of my tenants, who are the Apples and the Amazons and the Netflix of the world, have come to us and said, we need more space for less people. So we'll see how that sort of plays out when they actually start designing their space. But they have a lot of space. They built these facilities that have tons of amenity-based open airspace that they can convert to privatization or isolated areas that people can occupy. So that's exciting about that. But as I said, I'm bullish.
Got it. Okay. I want to move on to the second thing that's on everybody's mind, I think, which is obviously what still continues to be top of the news in the media, the coronavirus, the current economic environment. You mentioned that office, you've been seeing Netflix and other entertainment-related businesses wanting to expand. Curious to see how that's affecting your other non-entertainment related office tenants. But so yeah, just in general, I mean, how have collections been? How has leasing been on your office portfolio during this environment?
So Daniel, let me just jump into this a little bit, because there's so much around it that I think people somewhat understand and can relate to, and then other aspects that they can't. So let me sort of hit on a few of your points, and you can sort of get into it a little bit. Clearly, I'm talking my own book, right? Because I own office. So I own office in the best markets in the country, being Seattle, San Francisco, and Los Angeles. In terms of activity around those, my portfolio in general, our collections have been stellar. Across the board, they've been 95% in April, May, and June. And so we've done a great job in collecting, even when tenants in all of our markets have had the ability if they were under 500 people, they had the ability to withhold rent, and then they turn around, and as a result of that, they'll have to pay later on. It's deferred. It's not abated, but it's deferred. That being said, our retail tenants, which are for the most part, with the exception of a couple of assets that we own in Vancouver and in San Francisco, are amenity-based retail tenants for office. And those guys have been horrific. And candidly, I mean, I actually am shocked how low our collections have been. It's about 3.5% of our overall portfolio, but we're collecting sub 40%. And the guys that we are collecting are what you would imagine, banks. We're collecting non-service providers that are dependent upon tenancy flowing through buildings day in and day out. And what we've seen is not only are we not collecting, we've seen a lot of tenants who have come to us and asked for abatement or rent relief. And our response has sort of been very uniform, which is, hey, if you're not going to make it, we'll let you out of your lease so we can figure out what we want to do with most of that ground floor space. And the demand for that ground floor space has been for office tenants who want their own ingress and egress abilities so they can control their environments. So we'll see if that changes and what changes around that, but that's an optimistic aspect. In terms of leasing's been fairly myopic, and in terms of the day-to-day leasing from our standpoint, I mean, listen, we get updates on a weekly basis, and our team is cheering when they do 2 or 3 leases a week. When we were doing 20 or 30 a week pre-COVID. So as a result, clearly the leasing's not there. That being said, what we're finding is, as I mentioned, a couple of things. One, we've engaged with Gensler, who's really our architect du jour, that we end up using them regularly, and we're taking some vacant space, full floors, and looking at creating the new post-COVID space. And a lot of bells and whistles around that. We're going to spend a lot of money designing space that's going to be showcasing for tenants to end up moving into. As I mentioned earlier, tenants are looking for downsizing or space to accommodate less people for more space. Now, we had moved into a world where creative office campuses and creative space, I've used the phrase forever. I always said that is the definition of creative office space is less space for more people. And that's all they've done is they've taken the average square foot of an office space used to be around 220 to 250 square feet per head. And now it went down to, on the creative office side, to about 160, 150 square feet. That's huge. The reduction is like 40%. You're going the other way. So you're going to have the more space for less people. And that's where the future is going to be in terms of how people are going to adapt and adjust going forward. And we're seeing that already in conversations. And as I mentioned, they're taking conference room facilities or open air facilities, or they're gathering food environment facilities, and they're converting that space today to make it more accommodating for more people to spread out and be more comfortable. This is going to take some time on 2 levels. One, these companies they're mostly looking to do that in our portfolio, other than the entertainment side, is the tech companies. And so they've always been the leaders in desiring people to come back to deal with their culture. The irony here is when you see a guy like Jack Dorsey, who's a tenant of mine, not at Twitter, but his corporate offices for Square are all in our assets. He's told everybody at Square they're coming back to work, but he told nobody at Twitter to come back to work. So all these tech companies have built their whole environments around culture. And the culture is how they've retained and obtained high, quality employees to stay with them. How do you all of a sudden wake up and say, because of this, we're throwing our culture out? This is only a short-term window, and we're very impatient as a society, but eventually these companies will realize that they're going to lose employees to cultural companies that want people to come back to work. And and I know young people particularly want to be back in their social environments. And so they can't wait to go back to the office or to their social lives. And you're going to see that evolve over a fairly expeditious period of time between now and either the end of the year or when we have a vaccination or some form of function. The second thing is it's politically not correct for CEOs of America to say you got to come back. Unless you're immune compromised or you have child care issues or you've got some pre-existing condition, you will want to come back to work. And CEOs are going to want you to come back to work because they're paying you a lot of money to stay at home. The last aspect of the coronavirus that people aren't, the work from home thought process that people really aren't dealing with on a realistic level is work from home was mandatory when you had to be at home. Now that you're allowed out with face masks and social distancing and all your PPE, what you're finding is people are still getting up in the morning, going to get their coffee, going out to the park or working from other places. If that's the condition, you can start adapting to getting back to work. People are not going to move to, let's say, New York, graduating college, to be in a 600-foot apartment building to work from home. Why would they even move to New York then? Stay wherever they're from and work from your parents' house or your apartment, wherever you're going to be. So there's a lot of moving parts. There's a lot of unknowns. I do believe that people desire working with other people. It's hard for companies like ours or other companies to onboard when it comes to training and delivering materials or delivering just how the cultural aspects of a company work. So you're going to see that evolve in time as well. But as I said earlier, we're impatient. You want things to happen right away, and it's going to take a little time to adapt. But I do see that the office, which today has been not exactly the hottest commodity around, the office space will come back. It may look a little different, but it's definitely going to come back.
So it sounds like you think this whole concept of office not dying, but the demand for it contracting, people realizing they can work from home, technology today is different than it was 10 or 20 years ago. Office is to some extent becoming obsolete. You think that's completely overblown? You think
I do. I don't think it's overblown. I think there's going to be and I don't even think it's a happy median. I think it's a level of acceptability that people can work from home a day a week. Listen, the biggest issues are going to be public transportation, right? So cities like San Francisco, cities like New York have much bigger issues than cities like Seattle or Dallas or Los Angeles or Austin, where people can commute by their own cars. And there's a lot of cities like that, Denver, that are going to be great cities to go and see opportunities permeate. But I do think productivity will be impacted by people staying at home. Clearly, listen, we've all figured out how to use WebEx and how to use Zoom. And and I know every single time anybody's been on a Zoom call, there's been a problem. Every single time, whether it's a presentation, whether it's muting, whether it's a dog barking, whether it's kids interrupting, it's not as productive. You're not getting your messages across. I'm not seeing the type of presentations that I can see face to face. I'm lacking the ability of walking into a conference room and getting the real life feel of a team either presenting or interacting. And that's not going to be productive at the end of the day. So people will have to come into the offices. Acceptability, we'll see. How much that is it 3 days, 4 days a week? Maybe it's half day Fridays and Mondays. Who knows? I don't know where it's going to come, but I believe that even with the advancement of technology, as I said, with the exceptions of older people, immune compromised, people who have childcare issues, or people who are just truly nervous about this process, there will be a level of acceptability to stay at home. But eventually that's going to change too.
On that note, do you think the answer to this question depends on the type of asset class and the type of submarket? So for example, I think the urban office has really been the darling the past decade. Like you said, everybody, creative office, collaboration, more people in less space. Now people are talking about the suburbanization of office, which is really an inverse trend because pre-COVID, everybody thought suburban office was on the way out. Do you think there's any truth to that? Do you think that the answer, maybe one is improving, one is not? Curious to get your thoughts on that, on the dichotomy there.
You know what? Listen, I do think there's been a lot of banter around the suburban movement. I'm not so sure that tenants, one, are going to spend the amount of money to convert the suburban space the way they did in the urban space. So, the preponderance of my tenants, as I said, are media, tech, and entertainment. Those tenants have spent, literally hundreds of dollars a foot in the urban buildings that I own, improving those buildings so they have top quality assets for the markets that they're in. I don't see them spending that same amount of money in the suburban markets. So if they take space, maybe it's temporary. I think the thought process is a little backwards in that yes, you want people to say, okay, you can be in the suburban marketplaces, but then you're still dealing with the same issues in terms of onboarding, culture. So why not have them just work at home? Where is the reasoning to say, oh, we're leaving the urban markets because it's not safe and secure. We're going to go to the suburban markets, which is closer to people's homes, and yet you're not accommodating the same aspects of maintaining the culture of the companies that are going to be growing and moving forward. Unless the entire company is getting out of the urban marketplaces, which has been the case. I mean, and will be in some instances, but I don't think it's going to be as much as people perceive it to be. I do think markets like New York and potentially Boston and maybe San Francisco, but to the lesser extent San Francisco, I think are going to have some issues. Clearly, some issues. I can tell you, is the first question you'd asked me about, people coming back to work. I've seen a cultural shift that is concerning, that I think in time can dissipate, but initially is concerning, and lack of production is going to follow quite quickly after that, which is when I've seen people who been with me for 10 years who haven't been in the office much come in and they see their coworkers who they would known for 10 years or working together. I see a standoffish approach. I see people nervous about getting close. I see people worried about getting into elevators. That's time one, time two, time three. As it evolves, people will get more and more comfortable. 4 people in an elevator, wearing your PPE, dealing with that, and then going to your own offices, and then slowly integrating as time goes by. As I said, this will take time to adapt, but I can see initially it's going to be challenging. So just to say, let's go to the suburban markets, it's not going to accommodate the goals. You're still going to have challenging issues. People around people need to adapt around safety and security, and that's the process that we all need to figure out and get to that point where people are comfortable.
Got it. So expanding the discussion of coronavirus and its impact on office, from office to the general economy. What are your thoughts on what you think the economy is going to do over the next couple of years? What type of recovery do you think it's going to be? The class, is it V-shaped, U-shaped, W-shaped, Nike swoosh, check mark? Yeah, there's a lot of visual metaphors.
Yeah, I think we are proving it right now to be somewhat of a W, because we've already seen it come back up from a public market standpoint without any production. But I'm more optimistic around a V shape. I also have been in the public markets for many years, for 20 plus years in the public markets, and so the stock market is usually ahead of the curve as to what people perceive production. I do think that if you look at where we sit today, whatever you thought your EBITDA was going to be, or your earnings were going to be, or your NOI was going to be in your assets, you're wrong. This year is over. You can't make up for this year. When you lose 4, 5, 6 months of production, or you're down in terms of productivity, and your growth structure is impaired, that takes you, basically your year is over. So now you're shooting for 21. And there's a lot of variability around 21, whether it's what it looks like, how much money is going to be put into growing this going forward, and what people are going to end up spending their energy on in terms of trying to get productivity up and running. I do think that will, you are really looking at mathematically, it's very simple. If you lose 1 year, and you're going to take, 7 or 8 years at a minimum to make that 1 year up, if you have growth prospects of 10+%. So, and if it's just below 10, it's going to take 10 years. So these are years that you're going to have to see some level of productivity on a fairly ambitious basis to get us back to where we are. As I said, I'm optimistic. I don't count out America. I don't count out the ability for people to create value. Clearly, we have some huge hurdles with unemployment, with infrastructure plays, with virtually every state in the union is on the verge of bankruptcy and needs capital, and so you've got huge hurdles along the way that are going to impair us, and you're going to have to get through it. But I think, listen, the government's done a great job in providing a tremendous amount of PPP, and continually putting in more money into the system. How we pay for it, who knows? Generations like yours and even below you are going to be suffering from it. We all know that, but it's an absolute necessity for us to grow and try to get some momentum. And so I'm as I said, I'm optimistic on that basis. So if you're pressing me optimistically, I say a V, for two reasons. One is I like to see that as a recoverable aspect. Two, it's my initial. And two, I think if I'm more realistic, maybe we're coming down on the W and we come back up a little bit and then go back down again and then we go on our way. So, we're literally looking at 21, 22 basis here.
During this period until 2022, do you think there's going to be a lot of distressed deals? Everybody, a lot of vulture funds, private equity funds have been salivating throughout this entire bull market for another recession so they can kind of pick up bargains. Do you think there are going to be, as of now in the private markets, at least the bid-ask spread, as you know, has just been too wide. Buyers want those discounts, sellers won't give them, and they're not forced to give them. They shouldn't. So do you think you're going to see distress, bargain opportunities? And if so, or even irrespective of that, where do you see the big buying opportunity in the next couple of years, not including your asset class of creative?
No, I'll tell you. So listen, right now we are living in an environment where lending institutions, whether they're conventional banks or insurance companies, or they're second tier providers that are charging more higher rated debt, they are literally taking the approach that everybody, and I mean everybody, is too big to fail because they don't want anything back. The opportunities for them to take things back and manage it it's not possible at this time because they don't even have workout departments. There's not even people in these banks to do that process. So we are living in a false, sustained process right now where people think, oh, there's going to be massive opportunities. I think and I'll tell you what I really believe is sort of the best, and then the second tier best sort of areas to sort of focus on. You nailed it. There's so much cash still on the sidelines. It's beyond people's expectations as to even mentally try to figure out how much money is really out there, but it's huge. And so there's a lot of people with cash. There's a lot of people sitting on the sidelines ready to pounce. And I do think there will be distressed opportunities, but it will take time. And my guess is it's probably at the earliest fourth quarter this year, but probably more like starting next year, first quarter. Now, that being said, where do I see an opportunity in all asset classes is going to be on a mezz debt basis. And so I think a lot of owners of real estate need lifelines, and they're going to look at those lifelines through mezzanine debt or through some second structured debt convertible to equity, or even debt to own on that basis, because it's a lifeline that's going to get these owners of real estate to whatever that next level is, and then you're going to see what happens. So I think that's going to be an interesting opportunity for a lot of people to sort of focus on. You're going to get a current return if you can, or a deferred return, and you're going to be able to have a loan to own eventually on the assets anyways. And I think that's going to be across the board on all asset classes. When things shake out and lenders become a little tougher than they are today, or equity partners step in and say, we need management expertise because we're kicking out our operating partner, and therefore we're going to bring somebody else in on a levered basis or a second tier basis or mezzanine debt basis, and then figure that out.
All right. So, I mean, I think we only have 5 minutes left. I know you have a hard stop at 10:45.
I do, but you know what? I can a couple more questions and we can go.
Yeah, I think I want to bring Natalie back in. Obviously, I had a bunch more, but we got through a lot. Natalie, did you receive any questions from the audience that you think would be good to go over?
Let me look really quickly. There were some questions on sort of specifically asking how, Victor, you're looking at space planning going forward, and if you've been seeing tenants trying to get a different per square foot ratio on the properties that you're looking at, and whether or not it would be temporary or long-term.
So as I said, I mean, listen, on the square footage side, people are definitely trying to get more square footage, get back to that 250 range per head versus the 160, 170, 180 where we're at right now. It's some interesting things. So, you know, I do think when people come back to work and you are really, you know, getting into the initial aspects, you know, waiting, queuing in lobbies are going to be a very interesting aspect. You know, most landlords are not going to temperature check. There's going to be, you know, obviously mandatory PPE. And so that's going to be interesting. You know, what we've done is certain things like, you know, in our parking related buildings, you know, we've added repeaters. So when people have, let's just say they're used to be able to rush in your building at 5 to 9 for a 9 o'clock call, you know what, if there's a queue in the line, you can stay in your car. You're going to have good internet access to have your call until it's appropriate for you to get up, things like that. We are looking at older buildings and blowing out glass lines to have open air space, really actually open air space. If the engineering works and having that to actually have fresh air coming in. All of our buildings were adapted. So our systems are all updated. It's all the flow of air is natural flow. And we spent that amount of money and energy throughout the whole portfolio the last 5 years to accommodate that because of our ESG platform and what we've been working on that. I see that as being an absolute going forward. You know, and as I said earlier, you know, lower floors are going to be more popular than higher floors. People are going to want ground floor space, ingress and egress. We're opening up our stairwells to the first 5 floors for people to go up and down at various different times. We're talking to tenants about when their flow of traffic is going to be, so we know that if you're a finance company, some fire-related company who is around market timing, you're going to come in the mornings between 6 and 8. If you're more entertainment-related, maybe it's 8 to 10. And so we're going to have flowing differently. All that's going to see what happens when we get people back up and running, and you're going to see a lot more interesting attributes around that as well.
Okay. One other question from the audience, if we have time. We have
Sure.
time for one more. People want to know about the West Side Pavilion.
Yeah.
How's it going with Google? When can they go back into the area? What does it look like? Progress?
Yeah. So listen, West Side Pavilion is a super, super unique project, very exciting for us. We were all dedicated, and the construction was still in Los Angeles. We were considered essential workers, so we didn't stop. I think in the last 4 months, since March 13th, we had maybe a week of stoppage. And so we're on schedule and on time. Google has been vastly moving forward. The cool thing about that project is that prior to, you know, COVID, we had a tremendous amount of approximately 600,000 square feet is the overall project. So like 100,000 of it was going to be outdoor space anyways. And so we were working through that process. We made minor adjustments with them on that. And this is going to be the future of what campuses are going to look like with indoor, outdoor, a lot more heating lamps, a lot more balconies, a lot more workstations that are going to be accommodated to being outside. And yeah, Google's on track to move in end of 22. So we've got a little over a year and a half to go, a little less than a year and a half to go before they come in.
Thank you. It's 10:44, so I'm not gonna do any more questions. And I don't know.
Thank you guys. Listen, Daniel, Natalie, everybody on the Ziman Center, thank you so much for asking me to be here. It's a true pleasure. I wish everybody the best of luck. I know you guys got some messaging after, so I'll jump off. And let me know if you need anything else from Hudson. We're always here to help out UCLA and the Ziman Center.
Thank you.
Thank you, Victor. Thank you so much.
See you guys. Bye.
Thanks everyone for attending. And Dan, do you want to just give them a quick heads up on our next one?
Yeah, thank you so much, everyone. Hope you enjoyed it. We'll have another event in a couple weeks, July 21st. Mark your calendar. You're going to get an email as well. We're going to be having Tom McCarthy of McCarthy Cook. Really excited. And yeah, looking forward to that one and seeing everyone there.
Great. Thanks, everyone.
All right. Thank you.